Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the Relative Strength Index, also known as the RSI. This particular technical tool was developed by J. Willis Wilder. The Relative Strength Index is a momentum oscillator that measures the speed and change of price movements. RSI oscillates between 0 and 100. Let me show you that. Grab the tool up there. Alright, 100 will be up at the top and 0 will be at the bottom. Mark that. Traditionally, and according to Wilder, RSI is considered overbought when above the 70 line, this line right here. Alright, and oversold when below the 30 line. So it can also be used as an oscillator. Works very well in sideways moving markets. Signals can also be generated by looking for divergences and failure swings, also centerline crossovers. RSI can also be used to identify the general trend. So let's get into this and show you what all this can do. Let's clean that chart up. What the RSI is doing is it's analyzing the total number of down periods versus the total number of up periods, and that's being plotted on the relative strength index there. There's many different techniques for using it. But it can be altered dependent on the trader. According to Wilder, the default setting should be 14, and that's what most of your charts out there will be. You can change it to like a 10 if you wanted it to signal more often. That's one of the drawbacks with the RSI. I often use the slow stotch whenever I'm actually looking for an oscillator tool, find overbought, oversold signals. However, the slow stotch will signal much more often than the RSI will. So people ask me all the time, well, can I use the RSI? Yes, you can, but you probably want to adjust the setting to a 10 period to get it to signal more often. Otherwise, you're going to have fewer trade opportunities in that particular method of using the RSI. Should also be noted that the RSI will be more volatile if you're dealing with a more volatile security. If you're dealing with something that's very calm security, trading sideways, very slow moving security, then you may not see a signal at all for a prolonged period of time. So that's important to note as well. As I've said, the way to adjust the signal to create more signals would be to decrease the look-back period from 14 to 10. We may also increase it if you were looking at another longer-term chart and you didn't want to get signals that often. Another thing to note is that a lot of traders, if you're in a bull market, will adjust the typical reading of the RSI. For example, it's typical that you can see overbought conditions at the 70 line or above the 70 line and oversold conditions below the 30 line. Well, what they may do in a really bullish market is they will adjust it to say, okay, the overbought condition would be at the 80 line. So that was just something that they can make a personal little change of. And you may see that in a really strong bull market, that you'll find a situation where the RSI actually runs up and tags the 80 line or may even stay up elevated well above the 70 line. So that's important to note. The same strategy could be applied in a strong bear market where they, instead of looking at situations being oversold under the 30 line, they may look for it to be oversold under the 20 line. So just keep that in mind. You can adjust it dependent on the overall market that you're in as well. Now, one of the first things that you're going to learn to spot with the RSI is that whenever you have a situation where you have a strong bear market or a strong bull market, the RSI will reflect that to you from the center line being the exact center of the indication right here, the 50 line. Okay, whenever you are in a situation where the RSI keeps finding resistance at that level, you're typically in what's known as a strong down market or a bear market, and that's actually obvious here. Line that up right, and here. Okay, until you get that situation to change, it will continue to fluctuate within there. As long as there's a real strong downtrend, lots of selling and strong momentum to the downside, that's typically what you'll see there. Also, inversely, when you're looking at a strong uptrend, you tend to find support at that center line, that 50 line. That's pretty common as well. As I've stated, the RSI can be used as an oscillator to signal overbought and oversold conditions. Here's where overbought is during that time period. Here again, all right, in this time period. Where are we at? This one here, all right. And here again, and right here. Okay. You can also get oversold signals It's best if you work with the trend rather than against it. Here you'd be working against it. Oversold again, working against it. Here. Alright. And you also notice that in several of these cases, the signal is early compared to the actual bottom reversal or the top reversal. In some cases it's not. Here it's pretty accurate timed. Here it's pretty accurate timed. However, here you got an overbought condition and it took a while. Tops and bottoms can take a time to form. So just because you see an oversold condition or an overbought condition doesn't necessarily mean that it's immediately going to reverse in the opposite direction. In fact, if you had a very strong uptrend, you may see RSI pull up into the overbought condition and hug that line, just stay up there for an extended period of time. This can also show a strength in a particular security, not just oversold and overbought conditions. It's like most people tell you, whenever you're working with an oscillator for an overbought and oversold signals, it's best to work with a sideways moving asset. If you're looking at something that's just moving sideways, then it's a lot more accurate with the overbought and oversold conditions. Another thing you can do with the RSI is spot divergences. According to Wilder, divergences signal a potential reversal point because directional momentum does not confirm price activity. Here you can see that you've got a series of lower lows forming here, okay, and you're moving down here. However, the price activity, the momentum activity on the RSI is actually trending up during this time period, and this would actually be a bullish divergence telling you to look for a move to the other on the other direction. You don't just buy when you see something like this happen. You draw yourself a trend line and you wait for that trend line break. That's when you get your reversal. When price starts to confirm what you believe you're seeing, then you can take advantage of that opportunity. That would be the best way of doing that to protect you and save you from a lot of headache. Typically, if you're going to be seeing a bullish divergence where you've oversold, overshot too far to the downside, you want to see them develop near the 30 line like you have here. You've got one hitting the 30 line and come up here and hit it again or just above it. That makes sense. You're getting oversold reading by being near the 30 line, and you're also getting a bullish divergence. That makes sense. On a bearish divergence, it's the exact same thing. It's just inverted, completely flipped. Clean that chart up. Bearish divergence, you'll have a situation where you have a higher highs, and then you're going to be seeing an uptrend here. However, the corresponding high points on the RSI would be lower, and this would be showing a downtrend. That's a bearish divergence. It's telling you to look for a top is basically forming. And there's, again, you want to use price activity, let the low points get taken out before you decide that in fact it is time to start doing your selling activity, your shorting activity. Here, another method you may use is to wait for the RSI to fall down below the 50 line. When it falls back below the 50, that could be confirmation as well. You'll also note in this topping signal that you're getting here, this bearish divergence, you're again hitting that 70 line. That makes sense. You should be seeing a topping signal if you're up and around the 70 line. That would be logical, so that's confirming as well. Another signal you can get from the RSI is what they call failure swings. This pays no attention to price whatsoever. It's solely analyzing the RSI. The situation will develop when you have a pullback down below the 30 line like you did here, and then a bounce back above that 30 line, and then pull back down, making a higher low. You're not falling below the 30 line here. This is showing a little uptrend right here. This will be confirmed when this high point right here on the RSI is broken. When you have a breakthrough of that, he's getting a reversal signal. That happens right here. You reverse slightly there, like shortly thereafter. Here you've got another one. You pull back down below the 30 line, bounce back above it, and pull back to the 30 line, and then break highs, moving higher. This right here happened during that time period. Here over here, we can see a bearish failure swing where you have an advance up here above the 70 line, pull back down to just above the 50 line, pull back up and fail. We cannot touch the 70 line, and then pull back down and break into new lows. This would be a failure swing from a bearish perspective. It moves down here. These failure swings were developed by Wilder for the RSI. However, any bound oscillator it will work with. The Williams percent R it will work with. Fast Stotch, it would work with slow, of course, full Stotch. Ultimate Oscillator, it will work with any bound oscillator that allows you to spot those failure swings. You can also get situations known as positive or negative reversals. This is another type of divergence. And basically what you'll see is a series of high points, right here and here, higher. Yet price activity does not confirm that here and here. You'll notice that you are actually, let's see, right there, about flat. Okay, you're seeing that price is not actually capable of keeping up with the momentum. There's just not enough buying pressure there, and that could be a signal that you're going to reverse back to the downside. As always, use a resistance or support line analysis in this case. Whenever you break below that, close below that support area, then you can start to short it. But otherwise, you may continue to develop for an extended period of time, so keep an eye on that. Could have also drawn that like this. This point here, this point here. Corresponding highs here. Any one of these here. Remember when you're dealing with the RSI that you're looking at closing data. Even though I'm using candlesticks here, and a lot of guys will draw the trend lines and support and resistance lines off of high and lows. In a situation here, you're using the RSI uses close of each period, so you want to compare apples to apples, so use the close on your analysis. A bullish reversal occurs when, or a positive reversal occurs whenever you have a series of lower lows on the RSI and higher lows on price. Whenever you're seeing this situation develop here, and you start looking for a move to the upside. Again, you'll notice that the positive reversal will happen near the low 30 line, showing oversold. The negative reversal will happen near the overbought or about 70 line. Again, I'd like to reiterate, whenever you're looking for overbought or oversold conditions using the RSI, remember that when you're moving sideways, that can work oftentimes. It will work very effectively. When you're in a very strong bullish mode, you've broken out, making new highs, that kind of thing, you can get overbought and remain that way above the 70 line. So that's important to note. Just because you get up here above the 70 line doesn't always mean that you are quote-unquote overbought. So what you can do is simply monitor your low points, and when you start taking out lows, then maybe you can reverse the strategy. Here you've come down here, either made a new low or taken out one, so you can keep an eye on this. You start to develop into a series of a topping pattern will develop over time, basically, and so will a bottom pattern. So whenever you see them start to develop, don't jump in. Wait for it to start to confirm everything, okay? Now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.